Americans are voting. What they're up to as far as the results, no one knows, but that's not going to stop us here from pontificating about what might come after the outcome. Because besides the fact that, of course, everybody is watching and waiting for exactly what will come of this critical presidential election now upon us, we had economic data come out, and it told an interesting story about what the next president is going to have to deal with, whoever that is. And that's what we are going to explore here on Macro Money. I'm Ilya Spivak, head of global macro here at tastylive. Of course, we have to do the obligatory check of where markets stand as the voting commences. And the response from financial markets has been curious. Stocks having a strong day, up nearly 1.5% on the Nasdaq and the S&P 500, a little bit more for the Nasdaq, a little bit less for the S&P 500, but comparable gains there. Relatively stayed in the yields, long end basically flat, front end yields a little bit higher, crude oil higher, up almost 1%, gold a touch higher, up 0.3% almost, and the dollar getting overrun against almost all of its major counterparts, down against the euro, down against the yen, down against almost everything, and Bitcoin seeing strong gains. Now, it's tough to look at this and make much of it thematically. If you were going to tie this to some sort of policy proposals, perhaps the almost mythical now idea of a quote-unquote Trump trade, which would speak to reflation. Some of these things point in that direction, a little bit higher front-end yields perhaps, a little bit higher gold, a weaker dollar, but that's not been something that stocks have liked. And so to see them up here is a little bit different. And on the other hand, if we were to consider that reflation idea in sort of its full breadth, then the dollar should be stronger too. It has been benefiting from this reflation idea, creating the sense that the Fed might need to be a little bit more cautious about cutting rates. So a little bit inconsistent here and unclear what ultimately this price action says, other than in the past several days, we'd been up a bunch on the dollar. We're correcting. We'd been down a bunch on stocks. We're correcting. We'd been down a bunch on gold. We're correcting. On and on it goes. So if nothing else, this appears to be reflective of digestion, because the polls going into this as the voting began are locked in a dead heat. Harris is up by 0.1 percentage points in the latest aggregate from Real Clear Politics, which is essentially a coin toss. That is a difference that means very little. If we look at the various prediction markets, these are essentially betting venues and represent some amount of liquidity. Of course, not anything like representative of all of what's actually out there in terms of the potential voters and where they might go, and certainly specific to some demographic characteristics, but nevertheless, people are watching them and they are helpful in shaping perceptions. The onshore markets first, Kalshi with the edge to former President Donald Trump at 58, to Kamala Harris's, Vice President Kamala Harris's 42%. The predicted markets a little bit tighter, about 54 to 51 for Mr. Trump. Still his odds a little bit higher, but much, much narrower. Looking offshore, the spread basically 62 to 38 for Mr. Trump on poly market, but ostensibly this is a marketplace without Americans on it. Theoretically anyway, because it doesn't accept American clients, theoretically anyway. So with that in mind, we put the current price action perhaps in the context of Donald Trump having a slight lead as the voting continues, at least in the minds of these market venues. We'll see how this develops going forward. But while all of this was occurring, while that slight edge in betting markets perhaps gives an interesting context to these moves here, especially if the result ends up being one that favors Vice President Harris. Do we then see a reversal in stocks? Do we see a reversal in the yield curve? Do we see a pullback in gold, a rebound in the dollar? We shall have to wait and see. But while all of this was transpiring, U.S. economic data continued to tell a rosy picture. The service sector version of the ISM Purchasing Manager Index figures for October, they came out, and the numbers were white hot, much, much stronger than expected. 56 on the service activity index. That's this right here. And you can see that's the highest level since August of 2022 and follows on from a 19-month high in the prior month. So by any stretch of the imagination here, the U.S. economy is racing forward. The service sector is, of course, by far the largest component of employment, the largest share of GDP growth. And so to see this kind of dramatic reading is, needless to say, eye-catching. The manufacturing numbers from last week were much closer to expectations, a little bit soggier. As ever, these are PMI numbers, and so they operate around a logic where 50 is neutral, above 50 is growth, below 50 is contraction. The further you go above 50, the faster the growth. The further you go below 50, the faster the contraction. So what we saw was a little bit of a faster contraction, but not an unexpected one, as it were, for manufacturing. It was expected to contract at 47.6. It contracted at a slightly faster rate at 46.5. The story in services was actually that the expectation pointed to a slight, modest cooling after the surge that we saw in the numbers for September. And what we actually ended up with here was a very potent increase, a much stronger outcome. And when we look at the breakdown of the outcome, in the yellow bars is this green line here. That's the overall index, and then some of the key subcomponents here showing up. And you can see, although new orders growth moderated a little bit, still well above 50 and after a long run higher, and the price component inched a little bit lower, implying inflation is a little bit better, although that's been relatively steady essentially since the middle of last year, and generally anchoring since this spike at the start of this year. The real standout is employment. Employment was falling in the service sector, or at least employment growth was contracting. Jobs were being lost in the preceding 2 months. What we ended up with here for October's numbers is a dramatic jump in employment growth. In fact, that accounted for a good bit of why the overall numbers were higher, and this was the fastest pace of hiring in 13 months. So very, very strong numbers here for what is the driving engine of U.S. economic growth. Moreover, it comes after a series of increasingly better than expected economic outcomes out of the U.S. As a matter of fact, we can see from late August, U.S. economic activity has been steadily beating relative to baseline forecasts. This is an index from Citigroup. When it is above zero, U.S. economic data tends to outperform relative to expectations. And we can see why when the Fed started to talk about rate cuts back in July, when economic data was woefully tending to undershoot forecasts. The conversation was, oh no, the Fed has perceived some sort of weakness in the economy. That's why it's finally getting ready to pull the trigger on cuts. There's a recession coming. Well, what we've seen subsequently, after a bit of digestion, is that there's been an upturn in the data, and the U.S. economy is now performing hotter relative to forecasts anyway than it has in months, and is basically back to where it was mid-April, where deterioration around U.S. economic data flow starts to get the markets thinking in a more dovish way initially. We're basically back to where the U.S. economy's momentum looked to be after a melt up in the first quarter of the year. One would think this is good news for the world economy as a whole. After all, the U.S. is the world's largest. So if the U.S. is doing this well, one would think this is overall good news. But it isn't quite so simple. Looking at the way that global GDP breaks down, this is from the World Bank as of 2023, the last full year that we have, 26%, so over a quarter of global GDP is the U.S. The Eurozone is 15%, China is 17%. The remaining 42% are largely client or vendor economies for the driving three where most demand originates. And of course, China as a kind of middle of the supply chain economy also depends on demand from the US and the Eurozone, even as it feeds demand from early in the supply chain economies, be they commodity exporters in South America, in Africa, or in Southeast Asia, or materials producers in Australia and New Zealand. And so we have a situation where clearly the 26%, the US portion of this, is moving at a blistering speed. But when we compare with what's going on elsewhere, the story is much more sobering. So we just got the updated numbers for China this week. The official figures were effectively at standstill. This is the private sector estimate, which is a little bit better, as a matter of fact, just updated this week in the red there. That's from S&P Global and Caixin. The green is, just to compare apples to apples, the final reading on S&P Global PMI, composite PMI, taking together the manufacturing and services sectors. In the blue is what is expected to be confirmed when final revisions of Eurozone PMI numbers come out later tonight. And as we can see here, the story is vastly different. The U.S. is holding on to steady growth, having hit a 12-month high on performance back in May. After it hit that 12-month high, growth has held up at those levels. The situation in China has been absolutely woeful, but as we can see over the past 2 months, we've seen a little bit of a pickup. Nevertheless, we are still a very far way off from the pace at which the U.S. is moving. Remember, this is the pace of growth. And so what we see here is the world's largest economy is also expanding at a faster rate than the world's second largest economy, which, while finally expanding, is doing so at a much more sluggish clip. Which is not to overlook the euro area, which for 2 consecutive months now is expected to contract. That is, not to grow at all. So, of course, one begins to question how is it that the world's largest economy, the US, is growing so briskly, but everywhere else is kind of soggy. And indeed, if we look at global PMI numbers, they haven't been updated for October yet. We're still, as we just mentioned, getting final revisions from some figures. But we can see since May, global growth has actually been slowing, even as the US has been very robust over the same period. And we can see that it is the weakness at these other major nodes of growth, the Eurozone and China, that seems to explain what's going on here at a worldwide level. In fact, the composite here in the blue we can see has dropped at this point to the weakest growth since back in January. So a 9-month low. We'll see, of course, how the October numbers shake out, but looking at what we see here so far, maybe this story out of China gives us a little bit of a lift overall, but the gap continues to be yawning. And so the question then, of course, is, well, how come there is this weakness globally when the largest economy is so strong? And when we look at U.S. inflation data, the answer stares us right in the face. Obviously, when something is in demand, its price tends to go up as people bid up the supply that is available and compete to get it. This is economics 101, as it were. And what we find when we break down the contributors to the latest PCE inflation data, this is the Fed's favored inflation gauge, what we find is that almost all price pressure still lingering at this point lives in core services. Core goods at this point are now a negative contributor to inflation, as is energy. Housing is kind of locked in place, but comparing goods and services tells the really telling story. Because, of course, services in the U.S. are mainly domestic spending, whereas most imports, that is the kind of demand that might see U.S. vigor spill over into other markets because of U.S. consumers buying from foreign producers, that tends to be in the goods space. And so we can see with price pressures in services, that's where the demand is. With no price pressures in goods, that's where it isn't. And so what we see here is a vast bias in favor of domestic demand. As a matter of fact, if we look at the spread in percentage point contributions to overall PCE inflation from goods versus services, here's a spread, services minus goods, we can see the average is somewhere at 1.25. We are now at the highest level in nearly 2 decades. Meaning services is eating up a larger portion of U.S. demand relative to goods by the biggest margin in almost 20 years. This is why U.S. prosperity is staying largely on shore, why it isn't spreading elsewhere. Now, maybe this is ripe for normalization. Maybe it can stay dislocated for longer. We'll have to wait and see. Obviously, we've seen prolonged periods where these things are sticky at around these levels. So who's to say it doesn't continue? But of course, what this all means is troubling indeed for the world economy because of how central U.S. dollars are to global trade. Obviously, the natural thing to come away with from this kind of robustness in the U.S. economy is a narrowing in Fed scope to cut rates. And as a matter of fact, that's exactly what we've seen. Here's the initial Fed cut back in September. What we see is that since then, as we've seen U.S. economic data increasingly get better relative to forecasts, so too rate cut expectations for this year and next in some have narrowed. And we can see for this year, things are relatively anchored still at the 50 basis points that the Fed essentially talked themselves into in September. It's a little bit lighter in the markets. They're not quite fully baking in that second cut. One, of course, is on the menu for this week's meeting, and another more than likely, if we look at what the markets are pricing in, a very strong possibility over 80% for December. The action really is in next year, where the cumulative move has now shifted to less than 3 cuts, whereas the Fed envisioned 4 when it updated mid-September. And of course, what that's done is it's pushed up bond yields. In the green here is the U.S. 10-year yield. But since the U.S. dollar is such a ubiquitous unit of global economic exchange, increasing the cost of borrowing dollars also increases the cost of borrowing, period, because most transacting is ultimately done in dollars. As a matter of fact, the Bank of International Settlements last updated that the dollar is the vehicle for close to 88% of global monetary transactions, and no other currency, or even group of currencies, if you wanted to get all excited about the BRICS, are even remotely close, even in aggregate. And so when you get this kind of dramatic increase in U.S. yields, and the expectation is, well, perhaps you are going to get fewer rate cuts in the U.S., the response happens globally as well. The blue line is the average of rates in Germany, a benchmark for the Eurozone, the UK, Australia, and Japan. And of course, in those places, as we just saw, growth is not looking nearly quite so good. And the ability to withstand higher interest rates is much more diminished. So as we look for what this means for markets looking through this election, here's an important thing to keep in mind. At the beginning of the year, we've seen this movie. The U.S. economy at that time was improving. Here's the start of 2024. Economic data is getting better and then holding there relative to expectations. Rate cut forecasts come in. They get less dovish, from 2 to just 0.75%, and stocks can keep rising. Why wouldn't that happen this time? Well, at the beginning of the year, the global economy was accelerating. And so the global story overall was we can withstand higher rates. Growth is firming. We are not in that world anymore. And as this continues, if it continues, the story becomes quite troubling, because it suggests that we are going to see rising borrowing costs at a time when the global economy as a whole can ill afford it, and where that might tip the whole world into recession despite U.S. resilience. And that is macro money for today. As ever, we will continue watching these election odds and seeing what that is going to produce for us here going forward. Needless to say, this is very much a story in motion. We'll be here to cover it all, as ever, Monday through Thursday, right after overtime, a show that I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and where things may go therefrom. Back on with Chris for Futures Power Hour, Mondays and Fridays. On with Victor Jones for The Price of Truth on Wednesdays. Back with Victor and Tom for First Call on Sundays. Writing for the News and Insights portion of tastylive.com. And commenting on the platform formerly known as Twitter, at Ilya Spivak. If you're watching on YouTube, like and subscribe. Macro Money's back tomorrow.